how to easily outperform financial advisors, robo-advisors, and index investors. Well, that's what we're going to talk about today. So financial freedom is really what we're trying to get, financial security. We talk to people about their finances all the time. What most people want is just to know that their money is there and they can live their life the way they want. But very few Canadians actually get there. And the reason is very often because of suboptimal investments. Whatever your style is, whatever your strategy is, your method, most Canadians still end up with suboptimal investments and focusing on the wrong risk. So I can explain that to you and show you how to outperform all these different methods. So what we're going to learn today is, first of all, why is good performance important for your life outside of the obvious? What rate of return do you need to become financially independent? What are the four performance drags that reduce investment returns? What is the asset allocation loss ratio? Why is it easy to outperform financial advisors? And what is wrong with the investment industry definition of risk? Why is it easy to outperform robo-advisors? Why is it easy to outperform index investors? And we're talking about how you can learn to think properly about investing and what are the secrets to outperforming. Okay, so first of all, why is performance important? And the reason is you're trying to achieve, financial freedom, financial independence, retire comfortably at some point in your life, and really you can't do it without good investment performance. And it's more than just a standard. And I'll just give you an example. This is kind of a modest plan, but I've got other examples in other videos with, consider comparable plans and basic plans, or so for higher and lower income people. But so there's a couple age 35. They're going to retire at 65, 30 years from now. They make 50,000 each, so it's 100,000 total, and they will retire on 80,000. Okay, so and for 30 years, it's 3% inflation. Okay. And we're assuming all the maximum pensions. So if they get 5% a year, this is a typical balanced portfolio that you might get from a bank or something, right? So if they get 5% a year, they need to get $3 million by the end of that period, which means they would have to invest 34,000 a year. Now that's just ridiculous considering they only make 100,000 a year before tax. That's just completely ridiculous. And that's what happens when you end up with a balanced portfolio and just modest returns. You can't possibly have the future that you want. Now, if you had an equity portfolio, conservatively, you should be able to make 8% a year as a long-term return. Then you need 1.55 million. You need to invest 13,000 a year. That's not even maxing your RSPs. So this is not easy, but certainly doable. This is completely ridiculous. It's that difference, and that's why it's really important to outperform. So, and it's what leads everybody or most investors to these suboptimal investments is a fear-based mindset, and that's the problem. It's really completely impossible to retire comfortably with a balanced portfolio, but with an equity portfolio, you can do it. So to outperform, you need to have a growth mindset. And again, you can't retire comfortably on a 5% per year return of a balanced portfolio. So you need, comfortable retirement requires 7 to 8% a year that you would typically get from an equity portfolio. So you need at least that kind of rate of return to have the future that you want to have. And then what happens, after you retire? People say, well, after retire, I can go really conservatively. But I've done thousands of financial plans. I can tell you, if you retire at 65 and your money's going to last for 30 years, or 60 to 65, your money's going to last 30 years, somewhere between 70 and 90% of your retirement income is growth after you retire. So you still need good growth even after you retire. So now what happens here all the time is what I call the nightmare. This is like the worst case scenario, and it is what you see with a typical financial advisor every single day. So you sit down with an advisor, they don't do a retirement plan, they give you this risk tolerance questionnaire, you come out moderate, they sell you a balanced portfolio, and you leave, and you know what? You're already screwed. There's no chance you can have a retiring comfortably. You didn't do a plan, so you don't even know, and you're screwed. But the problem is this balanced portfolio. So why did they give you that? So here are the four performance drags. Here's the things that mess you up and mess most investors up. Okay, and you can easily outperform all these financial advisors, robo-advisors, index advisors, and even others, because they use these four performance drags. So first one is fixed income or bonds. I'll talk about that more, but a lot of them actually will try to, I call it forced bond investing. They actually try to force you to buy bonds. It's really, in the investment industry, there's a lot of forcing to buy bonds. Another one is home country bias. It's kind of a funny one. Riding the brake, lots of examples of this. It's basically investing too conservatively. And then it's just one idea investing. They will get one weird idea or something unusual idea that you think is great, but you've shrunk your universe. So all of these, what they have in common is they focus on short-term thinking and not long-term total return investing. That's what really works. So what you need is to invest for maximum reliable long-term total returns, not for reducing your short-term volatility. Okay, so talking about fixed income bonds, I've actually done other videos on the risk of bonds, and really, I mean, it's the bonds in the balanced portfolio that mess you up. And for the most part, if you have bonds or fixed income in your portfolio, you probably cannot retire with the lifestyle you really want. It's that simple. That's why I've kind of declared the death of bonds as a serious long-term investment for people that want to retire comfortably. And the problem with it is this: it's short-term versus long-term risk. Okay, so stocks go bouncing up and down, and you have significant short-term declines, but give it over time, and they rise, and they're actually quite reliable as a long-term investment. Now, bonds, on the other hand, and cash have this long-term risk, so they don't bounce around. See, that's pretty steady, but they kind of steadily lose money. They don't keep up with inflation. The returns are low. They're too low for you to achieve the goal that you want. And so this is the really big risk. It's not this up and down of your investments. So now, what that leads to is the asset allocation loss ratio. So because of your fear of the short-term investment or short-term declines, so you're going to do something to reduce volatility, and whatever you do is probably bad for you. Okay? So the AALR is going to reduce your returns. It's how much your returns are reduced by having a suboptimal asset allocation of your portfolio. Okay. And here's one example. 20% bonds, it's really common for people to have a minimum of 20% bonds, often much more. But a 20% bonds probably reduces your long-term investment return by 1% a year. So that's actually a significant amount that you're losing from that. So the asset allocation loss ratio. So again, it's how much of your long-term return you lose because of an inferior asset allocation process. So now number two is the home country bias. And this happens in every country in the world. They always think it's safer to somehow to have your money in your own country, which is weird. Here we are in Toronto. We're like an hour from Buffalo. So for people to have a lot in Canada here seems to make sense to a lot of people. But if you were to drive an hour away to Buffalo to put 30% of your portfolio in Canada would seem like totally stupid, right? It's funny how everybody thinks their own country is safer. And about 15 years ago in Iceland, their stock market completely blew up at a 93% crash, completely blew up. And I found out that Iceland investors had 80% of their money invested in Iceland stocks. And my first thought when I heard that was, Iceland has stocks? I can't actually think of one. So I looked it up, and the Iceland stock market is really a lot like Canada, like a few big banks and resource companies, but they had all their money in their own little country. So it's obviously stupid when you think of having all your money in Iceland. That's clearly stupid, right? But you know what? Canada isn't really much better. Like we're a big country geographically, but financially we're not that big of a country either. And it's basically dumb anywhere you do it, except maybe in the US, to have most of your or a big amount of money in your own country. It isn't actually any safer. Some people say, well, it's because of currency, but you can always hedge the currency. So just to give you an example here, the last 15 years, let's compare Canada, US, and global with their indexes. So now the returns the last 15 years have been a little bit higher than normal. So you don't expect these normal numbers, but as a comparison, you can see the difference. Canada did 9.4, US 15.3, global 12.6. So 1,000 in Canada grew to 3,800, US 8,500, globally $6,000. But see how much less you have by being in Canada. And that's, again, asset allocation loss ratio. Look how much lower your return is because you have Canada in there. The other problem with Canada is it's a very small part of the world. Like it's about 3% of the world's market. And in my opinion, it's not actually a proper portfolio. Like the TSX 60, our Canadian stock market index, isn't a properly diversified portfolio. If you look at the allocation, like it's about 70%, just three sectors. There's 14 different sectors, you know. It's basically financials, energy, and resources. We call it rocks, trees, and banks. But if you look globally, the countries are actually much larger and much more diversified. And you see there's good allocation to all the different sectors. So, and Canada, you think our companies are big, but they're not. They're actually the average company in our index is about the same size as in the emerging markets index. So we're Canada stocks are fairly small and almost all in three sectors. So, why would we want to be there? Now, number three, riding the brake, investing too conservatively. This is a really important one, and it's done in all kinds of ways. I've listed some of the most common ones here, but the entire investment industry is very creative and focused on finding all kinds of ways to reduce short-term volatility, and they do it for a few specific reasons. And it's because they're focusing on the short-term risk, But the problem is that short-term thinking is the risk. They're only focused short-term. And that's why they don't get you the long-term rate of return that you need. So all they're focusing on is, what happens if, the market plunges this year and you will lose money? What happens? And the truth is, the stock market, is quite reliable long-term. Even if you invest at the worst time, it immediately plunges. Just give it some time based on history. It always comes back, just give it some time and keep going. So now any method you do to reduce the short-term volatility probably reduces your long-term return. And you should just assume that. Anything that is less or more conservative, less volatile, probably lower long-term rate of return. So it's the suboptimal investments that you get. That's what happens as soon as you try it. So here's just some of the methods that this happens. So the most common is they put you into a balanced fund or asset allocation, or often you'll get a target date fund, which is bond. It gets to be more and more bonds as time goes on. Then there's various kinds of income investing. There's GICs and bonds, and there's income funds that have dividends or other kinds of investments that pay out a lot of income, but you're just focusing on the income, not on getting the return that you need to reach, to have the life that you want. Low volatility, it was a trendy thing a number of years ago, hasn't completely gone away yet. Investors say, oh, well, we get low volatility, as if, it's not going to go up and down much, which maybe it won't, but then you're probably also not going to get the return that you need. So smart beta was this kind of trendy thing that was out for a while. And then there's a variety of just conservative stocks. The idea is just buy conservative stocks. But again, conservative stocks are probably not going to give you this, the long-term total return that you need, for the future that you want. And the most common is you can buy, infrastructure stocks, there's dividend investing, real estate stocks, home country, because people think their country is safer. But there's so many different ways that the investment industry tries to, invest more conservatively. But but all the focus is on the short-term fluctuation, not on getting a return, and that's why it's so easy to beat them. So, number four, one idea investing, and I call this basically what you're doing is you're shrinking your universe of available stocks down to one subsector. Instead of saying, let's just find the best investments all over the place, we're going to say we're just going to take this one little piece over here and only look there. So why would you do that? Why wouldn't you look around? Because I can tell you, there's no one area that has all the best investments. So you got to, look around for it. So now a common one we see the one idea is dividend investors. Lots of dividend investors think that's the one idea. And actually, I did a video recently which saying dividend investing is a brain fart. So, dividend investors think that the dividend, they're getting some income, but they're not. A dividend is exactly the same thing as selling a bit of your investments. A bit of your money comes out of your investment. Don't believe me? Watch the other video. So it's basically a stock where the company forces you to take some of your money every once in a while. That's what a dividend stock is. Now, often those are the more mature, more stable companies. So it can be, it's a one idea of a way to find more consistent stocks. So that possibly can work that way. But you're paying extra on taxes, and again, not all the good stocks are dividend stocks. A lot of them are other things. So dividend investing is one thing, but it's I usually It's always much more effective to be like Warren Buffett and be ambivalent to dividends. It doesn't, I don't even know what your dividends are. You're investing to find the stocks with the right total return. So 25 years ago, I'm in Brampton, so Nortel was the head office there, and everybody had Nortel. They thought it was the blue chip stock. It was just had awesome returns for a few years. And people were piling into it as if it was you could have all your money in the one stock, and of course, that kind of blew up. So it's the problem with having all your eggs in one basket. So other trendy ideas: low volatility, smart beta. We had pot stocks, and just a few years ago, people thought that was amazing, but they blew up. Crypto was still out there. It's just kind of a one idea. So it just, I think it's kind of like gambling. But so these are all one idea, but it's not, a properly diversified portfolio focusing on the long-term growth that you need. So why is it easy to outperform financial advisors? Let's take these groups one by one and show you why it's so easy to beat them. So bottom line is they use all four of the performance drags, especially they have bonds, almost always they have a balanced portfolio or asset allocation or something, and they home country buys, always overweight in Canada, and there's very creative on all these, methods to reduce your short-term volatility. And a lot of people think that the reason financial advisors are easy to beat is because of their fees, and fees are a factor, but usually these performance drags are even a much bigger factor. So another big thing is they often use bad market timing. Like you meet with your advisor, they always feel they have to change something. And so basically what they do is sell last year's loser and buy more of this last year's winner. But it means what they're doing is selling high or selling low, buying high over and over again. So bad market timing is a big factor in it as well. And their problem is they focus on the short-term risk. Okay, it's the market fluctuations, not on your retirement goal. A big problem is there are tons of compliance rules, and your financial advisor is probably more worried about his compliance officer than about you. And that's why they try to force you to buy bonds. They're just somehow, suck you in, try to get you to buy bonds in some way, through the risk tolerance survey, that nightmare scenario where they just give you the risk tolerance questionnaire and then stick you with bonds. So that happens a lot. And a lot of it is for them it's also the marketing reasons. They think that if there's a big market decline and they haven't properly prepared you for it, then you're going to dump them and go find another one, another advisor. They don't want to lose their client. So these are kind of the reasons behind it, their justification. So, but all financial advisors do a risk tolerance, a questionnaire that's required. And it's basically so that you don't invest too aggressively. And that's important. However, almost none of them do a proper financial plan to see what's the life that you want to have, how do you want to retire, what's the lifestyle you want to have, and what return do you need to get. So, and because they don't do that, they end up investing too conservatively to achieve your goals. So they take precautions not to be too aggressive, but they don't take precautions not to be too conservative. So. And basically why they underperform because they use a thing called the words to watch out for are reasonable returns with less risk. Anybody who says that, they're going to underperform almost for sure. Those are the performance drags. So reasonable return with less risk, what's the AALR that it's going to cause? So now effective investing would be the maximum reliable long-term total return. That's what you want to get, not, reasonable return with less risk. Now, let's talk about robo-advisors. Why is it easy to outperform robo-advisors? And the big thing here, again, is bonds. They tend to stick you with bonds, and it's, again, forced. So, and often they have home country bias and riding the brake as well, but the bonds is kind of the biggest one that's always there. And, I actually talked to an engineer a few years ago. He's a young guy. He was about 28. He was knowledgeable about investing, long-term time horizon, aggressive investor. So he went to one of the robo-advisors, and he gamed their questionnaire. What he did is he answered every single question with the most aggressive choice in there. And at the end of it, they still, came out with he should have 80% stocks, 20% bonds. So he says, why do I have to have this? And he called in and talked to their portfolio manager. He says, I don't want to have bonds. I'm aggressive. I want to have the maximum return. Bonds are going to drag it down. And even talking to that person, to the portfolio manager directly, the best they could do was 10% bonds. But they always have to stick them with some bonds. And that's about protecting the robo-advisor company. It's not about what's best for you, especially in this story. Another interesting example is, 2016 when Trump got elected, there was a big shift in the market which surprised people. Like the market actually really took off, and there was like that day, and we had been in kind of a conservative mode for a while, where low volatility stocks actually look kind of good, and all of a sudden it shifted to a different kind of more of a growth market. In 2017 was a pretty strong growth year, and talking to a few do-it-yourself investors that are buying these robo-advisors, and one of them says, I have an index portfolio from a robo-advisor, but the first 6 months of 2017 up 1% when the index was up 11. Then how come I'm so far behind? I'm supposed to have the same thing as, like very close to the index. So I actually looked up what that portfolio had, and it turns out at the beginning of the year they had bought a low volatility ETF and smart beta ETFs and all these weird trendy things. Now, by the middle of the year, they're way behind, and they quickly switched back to the index. So, the 6 month statement showed, showed I believe it showed the broad indexes again. But, it's again, so this was what they did is they went to these trendy things, thinking it's somehow going to get you a better return and, less risk, but it doesn't. So this is the problem with robo-advisors. They do all these suboptimal things. Now, what about index investors? Index investors should have it beat, right? Because they're just buying an index and getting low fees, and they tend to stick with it. It should work. The problem is the way to do it properly. Hardly any index investors do it properly the way it should be done. So, and then basically you end up using bonds or home country bias. And I'll give you an example. So some of the most common asset allocation ETFs. So you're going to buy one ETF that covers everything. And what it is typically is something like 25% bonds, 25% Canada, 25% US, 25% international. People think, oh, you know what? That's diversified. And look, I got a bit of everything, and it's low fees. Look how good I'm going to do. But 25% bonds is an AALR of about 1.25%. So you've lost about 1.25%, roughly per year for the rest of your life from that. Then you've got 25% Canada, which is again going to drag down your performance. The highest growth area recently has been the US, and they're drastically underweight the US. So, the actual index. So the US right now is actually about 70% of the world stock market, 70, not 25. And Canada is 3, not 25. So you're drastically under US, drastically over in Canada, about right for international. But that's not a proper portfolio at all. So now here's the thing. So if you're an index investor, generally you should probably only have one ETF, one investment. Pick a MSCI Global or Global All Cap or the S&P 500. Have one ETF, and that's all you use. And basically, then you're going to get close to the full return. But somehow your brain tricks you into thinking that you're not diversified. But if you have the World All Cap Index, the ACWI, then that is the most diversified you can possibly be. By adding a second thing, what you're doing is you're overweighting that sector and you're less diversified. So the most diversified is one investment, not more than one. But when I see index investors, they always have 4, 5, 6 different investments, and that's why they're so easy to beat. They're all things like that. They're overweight their own country. They stick some bonds in there, or they'll pick like the V Grow, for example. It's 20% bonds, and they think it's a growth because it says growth in the name, but they're not looking at the asset allocation. So lower fees, you get lower fees with indexes, but the AALR is usually larger than any fee savings that they get. I see index investors say, yeah, instead of paying your 1% fee, I bought an index and I am getting a 0.2 fee. Yeah. But then they have this inferior asset allocation, and it's still easy to outperform these people. That's what's wrong with index investors. So now how can you learn to think properly about investing? Basically, you're going to look for the maximum reliable long-term total return. That's what we do. And stocks, which are, also called equities, they're the highest asset growth, and they are reliable as a long-term investment. I'll show you that very briefly going forward. Now, you need to have the risk tolerance for this, but risk tolerance is a learned skill. I've had other videos about this as well, and the way to learn it is study the long-term market, see how it does, what the long-term history has been, see when there are crashes, how big are they, how long do they last, how long it takes to get back. So, the market has recovered from 100% of the declines in the past. So it's gonna recover. So the only question is how long. So a proper equity portfolio is a reliable long-term investment. And it's actually, believe it or not, it's more reliable than having bonds or a balanced portfolio or whatever you think is more diversified. Equities are actually more reliable. I'm going to show you that in a minute. So the worst 25 return of the S&P 500, the modern stock market, is 8% a year. That's the calendar return since 1930. But 8% a year is the worst that has happened. So, and if as soon as you're into a balanced portfolio, you're almost for sure not going to get 8. So that's the long term, again, that's important. So I call it turbulence tolerance. Like I learned that from being in a plane. Like in a plane, you get, and when I was first flew, I was very, scared of the planes and all, whenever you get a little bit of turbulence of grabbing my seat. And then after a while, after you've flown for a while, you realize, oh, that's just what happens. You just get some turbulence. But, the worst thing you can do when the plane gets turbulence is jump out. That's just the worst thing. And it's the same thing with when you have your stock market portfolio, you get some turbulence, don't jump out, just stay in. And the flying is the fastest, most reliable way to get to your goal. It's actually safer than driving or biking or walking or any other slower method. It gets you there faster, and it's the most reliable. Same thing with the stock market. So, but basically you need a method you are confident in. And what's going to happen is there's going to be, whatever stock market investment you have, there's going to be times when it's down, or where things look bad, or even where it does worse than other types of investments. Nothing works all the time, but you need something that you're confident in. And a good broad index, one index, is a good way to do it. Or we do it with all-star fund managers. We have our portfolio manager finds the world's best fund managers, and they all have long-term track records beating indexes after fees. So we get these really good long-term returns, but we get also the confidence that the fund managers there, whatever happens to the market, these super smart fund managers are going to make whatever changes we need to be. So you need a method, something that's going to give you confidence, so that you can stick with your investment when it's down. So. Now, investment risk that affects your life, what is it? So basically, it is the risk of not achieving the life that you want. So it's not the short term, what if the market declines? What if the market falls by 20 or 30% this year? But if it falls by 30% and comes back, that's not actually risk. You didn't actually lose anything as long as you stayed in. So, but, if you make 7% long term or 5 instead of 8, that does affect your life, and that is real risk. So basically, your financial plan should tell you the rate of return you need to have for the life that you want. Detail the life that you want, see what rate of return you need, invest to get at least that rate of return. And that's the long-term risk, is getting less than that. If your financial plan shows 8% a year, then risk is your long-term 25, 30-year return is less than 8% a year. That is the definition of risk. If it falls 30%, who cares, because it'll bounce back. As long as you get 8 or more as a long-term return, all the ups and downs are irrelevant. So that's how to think effectively about your investments. Okay. So long-term risk is what affects your life, and it gives you this growth-focused, optimistic view of the world. The world's getting better all the time, and that when you have that optimistic view, that's what really works. Now, risk tolerance. Lots of people talk about it. It's a learned skill. It's the ability to do nothing when your investments go down. That's all it is. It's these complicated questionnaires and all this stuff. It's just all you have to do is do nothing. And this is very quickly, but this is a 200-year chart. I've shown this on a bunch of other talks, but notice how consistent stocks have been on this trend line through everything that's happened in the last 200 years. All kinds of things have happened in the last 200 years, much worse than anything going on now. And, long term is, 6.8. Basically, it's stock markets has long term returned about 7% above inflation. So, but if you look at bonds are not that consistent. Like you have 40-year periods where they lose money and 40-year periods where they do reasonably well. But they're not that consistent, strong, really, good rate of return. And I'm showing you this to say stocks are reliable as a long term return. So, This one is actually really interesting and shocks people because everyone says, of course, bonds are less risk. It shows standard deviation and it's a picture of risk. So stocks, bonds, cash. So for 1 or 2 or 5 years, stocks are riskier than bonds and cash. Right out they are. But when you get to 10-year, not much difference. And 20-year, here's the shocking thing. When you get to 20 years, if you invest for 20 years or longer, which basically everybody is if you're investing for your financial independence or retirement, then stocks are less risky than bonds. They're more predictable. We can more accurately predict where the stock market will be after inflation 20 years from now than bonds. And that's why it's the better return and the more consistent rate of return long term that makes the stocks the perfect investment or the best investment for your retirement. So, and this is Canadian market, but you see it goes up and down. The yellow are all the declines, the bear markets. But notice when you see them in perspective, as long as you just stay with it, it always comes back, and you see that it's if you back up and see it's definitely trending up, even though it's had all these major declines. 40% declines in there, a few of them, and yet it's still a good rate of return long term. This is the U.S. market since 1871. 1-year returns look all over the map. Hard to predict. Get to 25 years and look how calm and peaceful, look how consistent it is. So then again, so this is the modern stock market from here. Before that, it was mostly railroad and agricultural stocks. But see, the worst it's been is 8% a year. So see how calm it is when you're in for 25 years. So just invest it and don't worry about it. Be confident about it long term. So stock market predictions, whenever someone asks me to predict the stock market, I have the same opinion. I don't know what's going to happen this year. I was an opinion, but I don't really know what's going to happen this year. But I do know that 25 years from now, the stock market will be 7 to 17 times higher than today. And that's always happened in the past. It's going to be between 7 and 17 times higher. And that's why you need to stay invested. So the secrets of outperforming, here we go. Number one, invest 100% global or U.S. equities. Like, don't have an AALR. Don't get a worse return because of a poor asset allocation. Forget bonds. Forget the home country. Just be diversified. Get to all long-term global U.S. equities. When the market's rising, get all the return. Like, so don't try to predict. Like a lot of people, when the market's going up, they're trying to guess at what point should they get more conservative to lock in their gains. Don't, just stay with it and get all the gain. When it's rising, you got to get all the gain. So then buy more when stocks are on sale. So whenever it goes down, don't think of, oh, my stocks are down. Always think of stocks are on sale. Is there a way that I can, invest more, take advantage of this while they're down? And a simple way, some people say nobody can beat the index. I'll tell you a simple way to beat the index. You buy an index fund and then you buy a regular amount in it. And whenever it goes down, you put extra money in. That's it. If that's all you do, you're going to outperform the index. It's that easy. Because from then on, from the low point, it's gonna outperform. Then it'll do better than starting on average. So avoid those 4 performance drags. It's really important to avoid them all. Be confident in the long-term growth, especially when your investments are down. And then, once those are the basic ones. And then if you want, you can go for, above index investing. If you get an index returns or very close to it, that's very solid and it can give you the life that you want. But if you can invest above index, like we use all-star fund managers that have been outperforming the index. So if you can beat the index, that's even better. And then the best method for growing wealth is leverage. Again, this is not for everybody. This is borrowing to invest. It's the Smith maneuver. There's the Rempel maximum. There's different ways to do it. But when you're using other people's money to borrow to invest, and you do it, it's a great strategy for the right people, done the right way over the long term. So these are the secrets to outperform. And if you do these right, you're going to outperform all these other different investors. All right, so this is basically what we covered today. Just as a quick review, we covered why it's important. Good performance is important in your life. What rate of return you need to become financially independent. What are the 4 performance drags that reduce your investment returns? What's the asset allocation loss ratio, AALR, important concept. Why is it easy to outperform financial advisors? And what's wrong with the investment industry definition of risk? Why is it easy to outperform robo-advisors? Why is it easy to outperform index investors? How can you learn to think properly about investing? And what are the secrets to outperforming? All right, thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. It's just my name, www.edrempel.com. or it's unconventionalwisdom.ca. It's not .com, it's .ca because I'm in Canada and couldn't get the .com one. If you want to potentially talk to us about being a client, we offer a free 30-minute consultation, edrempel.com/talk. I also have a podcast on YouTube. The podcast is edrempel.com/listen. The YouTube is edrempel.com/watch. Thanks for listening, and we'll talk to you next week.